Welcome back to the channel. Today we're diving deep into one of the most sobering statistics in trading. Did you know that only about 5% of Forex traders actually make consistent profits? That means 95% of people who enter this market will either lose money or break even at best. But why is this number so staggeringly low? And more importantly, what separates that successful 5% from everyone else? If you've been trading for any length of time, you've probably experienced the frustration of seeing your account balance swing wildly or slowly drain away despite your best efforts. You're not alone, and there's nothing wrong with your intelligence or capability. The harsh reality is that most traders fail not because they lack the ability to learn, but because they fall into predictable psychological traps and make fundamental mistakes that the market ruthlessly punishes. The first and perhaps most critical reason why so many traders fail is poor risk management. This isn't just about setting stop losses, though that's part of it. Risk management is a comprehensive approach to protecting your capital, and most new traders get this completely wrong from day one. They risk too much per trade, they don't understand position sizing, and they treat their trading account like a casino bankroll rather than a business investment. Let's talk about what proper risk management actually looks like. Successful traders never risk more than 1 to 2% of their total account balance on any single trade. This means if you have a $10,000 account, you should never lose more than $100 to $200 on one trade. But here's where most people go wrong. They see this rule and think it's too conservative. They want to make money faster, so they risk 5%, 10%, or even 20% per trade. They justify this by saying they're confident in their analysis or they need to make up for previous losses quickly. This approach is mathematically disastrous. If you lose 20% of your account, you need a 25% gain just to break even. Lose 50% and you need a 100% gain to recover. The mathematics of drawdown work against you exponentially, and this is why even traders with good win rates can still blow up their accounts if they don't manage risk properly. But risk management goes beyond just position sizing. It includes understanding correlation risk, where you unknowingly put on multiple positions that all move in the same direction, essentially multiplying your risk. It includes time-based risk management, knowing when not to trade during high-impact news events, or when market conditions are unfavorable for your strategy. It includes having maximum daily, weekly, and monthly loss limits that you stick to religiously. The successful 5% understand that risk management isn't about limiting profits, it's about ensuring longevity in the market. They know that the most important rule in trading isn't about making money, it's about not losing money. Because if you can avoid large losses, the profits will take care of themselves over time. Moving on to the second major reason for failure, and this is where things get really interesting from a psychological perspective. Trading psychology is probably responsible for more account blowups than poor technical analysis or lack of market knowledge. The human brain is simply not wired for successful trading. Our evolutionary programming that kept us alive as hunter-gatherers works against us in the financial markets. Fear and greed are the two primary emotions that destroy trading accounts, but they manifest in ways that most traders don't even recognize. Fear causes traders to exit winning trades too early, missing out on the big moves that could make their month or year. It causes them to hesitate when they should be taking clear setups, missing opportunities while they overthink. Fear also causes traders to move their stop losses further away when a trade goes against them, turning small, planned losses into account-threatening disasters. Greed, on the other hand, causes traders to stay in winning trades too long, watching profits evaporate as they hope for even bigger gains. It causes them to risk more than they should because they want to get rich quick. Greed makes traders take setups that don't meet their criteria because they don't want to miss out on potential profits. It makes them overtrade, taking too many positions and wearing themselves out emotionally and financially. But there's another psychological factor that's even more destructive than fear and greed, and that's the need to be right. Most people enter trading with the mindset that they need to predict where the market is going. They develop strong opinions about currency pairs and become emotionally attached to their analysis. When the market moves against them, instead of accepting they were wrong and taking their small loss, they hold on, hoping the market will turn around and prove them right. This need to be right is devastating because the market doesn't care about your opinion. The market is not trying to prove you right or wrong, it's simply moving based on the collective actions of millions of participants. Successful traders understand that they don't need to be right about market direction. They just need to manage their risk properly and let their winners run while cutting their losses short. The psychological pressure of trading is intensified by the fact that you get immediate feedback on your decisions. In most professions, you can make a decision and not know if it was right or wrong for weeks, months, or even years. In trading, you know within minutes or hours if your decision was profitable or not. This creates an addictive cycle similar to gambling, where the immediate gratification or punishment from each trade affects your decision-making for the next trade. Another major psychological trap is revenge trading. This happens when a trader takes a loss and immediately tries to make it back by taking another trade, usually with larger size. The emotional pain of losing money creates an urgent need to recover, which leads to poor decision-making and often even bigger losses. Successful traders learn to walk away after a loss, process what happened, and only return to the market when they're in the right emotional state. The third critical factor separating successful traders from the rest is their approach to learning and improvement. Most failing traders treat trading like a hobby or a way to make quick money. They spend more time looking for new strategies or indicators than they do analyzing their own performance. They jump from system to system, never giving any approach enough time to work, always looking for the holy grail that will make trading easy and profitable. Successful traders, on the other hand, treat trading like a business or profession. They understand that there's a steep learning curve, and that consistent profitability takes time to develop. They focus on one or two strategies and master them completely rather than trying to learn everything at once. They keep detailed trading journals, analyzing not just what happened in each trade, but why they made the decisions they did and how they felt during the process. This brings us to another crucial point about why most traders fail. They lack patience and realistic expectations. The internet is full of stories about traders making 100% returns in a month or turning $1,000 into $100,000 in a year. While these stories might be true, they represent extreme outliers, not typical results. Most successful professional traders are happy with 20-30% annual returns because they understand the importance of consistency over flashy performance. New traders often enter the market expecting to double their money quickly. When reality doesn't match their expectations, they become frustrated and start taking bigger risks to try to achieve unrealistic returns. This leads to the boom and bust cycle, where they might have a great month followed by a devastating loss that wipes out all their progress and more. The successful 5% understand that trading is a marathon, not a sprint. They focus on consistent, modest returns that compound over time rather than trying to hit home runs with every trade. They understand that a strategy that makes 2 to 3% per month consistently will outperform a strategy that makes 20% one month and loses 25% the next month. Market conditions also play a role in trader success rates. Most new traders start learning during trending markets, where many strategies work well. They develop confidence in their abilities during these favorable conditions, but when market conditions change to choppy, sideways action, their strategies stop working and they don't know how to adapt. They keep applying trending market strategies to ranging markets, losing money consistently. Successful traders understand that market conditions are constantly changing and they need to adapt their approach accordingly. They know when to be aggressive and when to be conservative based on current market structure. They understand that some periods will be more profitable than others and they plan for this variability. Let's talk about the role of discipline in trading success. Discipline is what allows you to follow your trading plan even when your emotions are telling you to do something else. It's what keeps you from risking too much when you're feeling confident after a series of winners. It's what prevents you from abandoning your strategy after a string of losses. Most failing traders have good knowledge and even good strategies, but they lack the discipline to execute them consistently. Discipline in trading means having a written trading plan that covers your entry and exit criteria, your risk management rules, and your daily routines. It means following this plan exactly, even when market conditions look different than usual, or when you're feeling particularly confident or fearful. The successful 5% understand that their trading plan is their edge, and deviating from it is what turns them into part of the 95% who lose money. Another factor that contributes to the low success rate is inadequate capitalization. Many traders start with accounts that are too small to trade effectively. They try to trade standard lots with $1,000 accounts, which forces them to use excessive leverage and take on too much risk per trade. Even if they understand risk management intellectually, they can't apply it properly because their account size doesn't allow for appropriate position sizing. The successful minority usually start with adequate capital, or they build their accounts slowly using micro and mini lots until they reach a size where they can trade effectively. They understand that undercapitalized accounts lead to emotional decision-making because every small loss feels significant when your account is tiny. Technology and execution also play a role in success rates. Many failing traders use unreliable brokers with poor execution, wide spreads, or questionable practices. They might have good analysis and proper risk management, but poor execution eats away at their profits and increases their costs. Successful traders invest in quality brokerage relationships and understand the importance of execution quality to their long-term profitability. Finally, let's address the elephant in the room. Many people enter Forex trading because they've been sold on the dream of easy money and financial freedom. They've seen marketing materials showing luxury lifestyles funded by trading profits. This creates unrealistic expectations and attracts people who are looking for a get-rich-quick scheme rather than a legitimate business opportunity. The successful 5% entered trading with realistic expectations or developed them quickly through experience. They understand that trading is a skilled profession that requires continuous learning, emotional control, and disciplined execution. They're not looking for easy money, they're building a long-term business that happens to involve financial markets. So, what does it take to join that successful 5%? First, develop and stick to a comprehensive risk management plan that protects your capital above all else. Second, work continuously on your trading psychology, understanding your emotional triggers, and developing systems to manage them. Third, treat trading like a business with proper planning, record-keeping, and performance analysis. Fourth, maintain realistic expectations and focus on consistent returns rather than spectacular profits. And finally, be prepared for a long learning curve and understand that overnight success in trading is extremely rare. Remember, the 95% failure rate in Forex isn't because trading is impossible or because the markets are rigged against retail traders. It's because most people approach trading with the wrong mindset, inadequate preparation, and unrealistic expectations. The market is beatable, but only if you're willing to do what the successful minority does, rather than following the crowd into common mistakes. If you found this information